Well, hello and welcome back to Katie's Business Tips. Michael Lapede here, starting a new mini-series on structuring your investments. How do you structure? Where do you invest from? Most people just say, well, I'm going to just invest personally or invest from my RSP. Well, those are options, but there's more. The first question you got to ask yourself is the investment a Canadian local investment, or are you investing in companies or assets or other investments offshore, outside of country, US or any other country for that matter? Because that affects your structure. Second is, are you going to invest using your own money, borrowed money, or are you pooling money with others? Because that will also determine what structure or what structures you should use. And the last one is what type of returns you'll be receiving. Interest, capital gains, dividends. You know, a lot of people don't realize when they put money into an RSP and they invest and they have capital gains and dividends that they're losing out on the benefit of those. So if I make $100,000 in capital gains as an individual, I only pay tax on $50,000. If my RSP makes $100,000 and I pull that out later, $100,000, I pay tax on the full $100,000. See, I pay double the tax by having capital gains and dividends. You know, capital gains particular is double and dividends is higher. Inside an RSP. So a lot of times we don't want to use the RSP for those types of investments. Now we also got to look at, should we use a corporation? There's times to use a corporation, but a corporation is taxed at a higher rate. So we got to consider the time we would use a corporation to invest would typically be when we have money coming into that corporation that's tax-free or low taxed, and we have more to invest because we're going to pay higher on the returns. But if we take out the money personally, we're going to pay a bunch of personal tax and then have less to invest. So typically the corporation's better to have more to invest is why you might use a corporation. Now there's also cooperatives and partnerships that you might use, but at the end of the day, the structuring is going to be a case-by-case basis on what you're investing in, like what kind of returns, where you're investing, and these questions we asked you, as well as are you pooling and so forth, right? Now, if your investment is going to be onshore, then typically, you're going to be an onshore structure. If it's offshore, you'll be an offshore structure as well. And when your offshore structures are very similar, they have trust corporations in the US and other jurisdictions. And if you're going to pool money, we're going to use certain structures to pool the money. We're not just going to joint investment personally with someone, that's outside of your realm. Now, if it's your spouse, that's a different story, obviously. But if it's a friend or a sibling even, you want to structure things in a way that has an arrangement, agreement. If it's a corporation, you might have a shareholders agreement, or you might have a joint venture and you're using a joint venture for your structure to invest. But make sure there's an agreement in place no matter what structure you're using when you're pooling money. And if you're borrowing money to invest, you want to structure it in a way that you're going to write off the expenses of the interest and carrying charges of what you borrowed. Now I know there's a lot of questions around this because it gets very complex, but again, it's a case-by-case scenario. So don't hesitate to post your comments or send us an email and we'd love to answer you. Subscribe if you haven't too, and we'll see you in the next video.